Hi everyone, and welcome to this week's episode of Kickstart Your Real Estate Investing. In this week's episode, I'll take the next financial metric, which is the gross rent multiplier. So how do you calculate a gross rent multiplier? It's a very simple formula. You find out by taking the fair market value of an investment property and you divide that by the gross rent you can make on that property. So in the simplest of terms, it just looks at two variables. One is the investment property's fair market value, which you might pay when you buy a property, and the gross rent which you can receive from that property. Okay, so let's take an example. Let's say you're looking at an investment property which with the cost is $100,000, and you find out that the gross rent you can make on that is $25,000 per year. So the GRM, or the gross rent multiplier, for this particular property will be $100,000 divided by $25,000, and the answer is 4. So the gross rent multiplier for that particular property is 4. Now let's assume you're looking at another property in the same market. The price for that property is also $100,000, but the gross rent you can make on that property is $20,000. So in this case, the GRM, or the gross rent multiplier for that property, will be 5, which is $100,000 divided by $20,000. So if you're just looking at these two properties, you can very easily see that the GRM of property 1 is 4 and the gross rent multiplier for the second property is 5. A lower gross rent multiplier would indicate you would be able to use the funds to pay off your loans or pay off your property sooner. So lower gross rent multiplier is considered to be better than a higher gross rent multiplier. So 4 is better than a 5 in this particular ratio. Okay, but keep one thing in mind: the gross rent multiplier is a very quick way to understand which properties you want to consider. But you should not just use that one particular metric. You should go one step further and do a more detailed analysis to understand what is my cash flow going to be from these properties, right? Because you might have a gross rent multiplier of 4 and comparing to a gross rent multiplier of 5, but you might find that the cash flow from the second one might be better than the first one, right? So what if the first one, which has a gross rent multiplier of 4, has a higher expense ratio, right? It might have more expensive, it might have more capex you might have to put out there. And you might get a higher rent, but your expense is also higher, which will reduce your cash flow. So you should always look from that perspective of, I'm just going to evaluate whether these two properties or these 10 properties are within each other from a gross rent multiplier. If one's gross rent multiplier is 4 and the another one's gross rent multiplier is 15, then you know the 4 is always going to be better than 15, right? But if another gross rent multiplier is 5, then you might want to consider what is the net operating income for that one, what kind of cash flow I'm going to get from that one, because they're very close to each other. Okay, so use the GRM, or the gross rent multiplier, as a very first level, as I want to very quickly figure out whether this property is even worth looking at. Okay, and then once you identify a few properties with the GRM looks good to you or makes sense for you, then you can go into the detailed analysis and start looking at it, let's say, from a cash flow analysis or net operating income, cash on cash return, all of the metrics which we spoke about. You can then start getting into that. All right, folks, this was a very small session this time around because it was a very simple concept, but I still wanted you to be aware of this concept because it's something which you might come across as you start evaluating investment properties. So if you like this episode, please go ahead, add some comment, give me your feedback so that I can improve the way I do all these particular sessions. And please go ahead and subscribe to my channel. Thank you. Bye.